We just saw something that wasn't supposed to happen. JP Morgan, the biggest bank in the United States, the bank that survived the crisis in 2008 when Lehman Brothers fell apart, the bank that government officials say is the best example of managing risk, just missed a margin call. Not a small one, not a computer mistake that gets fixed in one afternoon. A serious margin call connected to derivatives exposure so big that the process of fixing it could break the entire system that global finance depends on. And if you think this is just another news story that will disappear by next week, you completely misunderstand what a margin call at this level really means and what it causes to happen. Before we go further, make sure you hit that like button and subscribe, because what I'm about to explain to you isn't getting covered anywhere else with this level of clear detail. Here's what actually happened. JP Morgan holds a derivatives book worth over $45 trillion in notional value. That number is not a mistake. 45 trillion. To help you understand how big that is, the entire GDP of the United States is around $28 trillion. This derivatives book is a network of interest rate swaps, credit default swaps, currency forwards, and equity derivatives that connect JP Morgan to every major financial institution on the planet. These contracts require collateral. When the value of these positions moves against you, counterparties demand more margin. That margin has to be posted in cash or highly liquid securities, and it has to be posted immediately. JP Morgan just failed to post that margin on time. Now, let me be very clear about what a margin call failure means at the institutional level. This is not about JP Morgan running out of money in some simple way. JP Morgan has assets, it has deposits, it has reserves at the Federal Reserve. But here's the critical structural point that separates institutional finance from anything retail investors experience. Liquidity and solvency are not the same thing, and in a derivatives book of this size, liquidity is everything. A margin call isn't a polite request. It's a contractual obligation that triggers within hours. Every other bank, every hedge fund, every sovereign wealth fund that has exposure to JP Morgan through derivatives, repos, or credit lines immediately starts reassessing counterparty risk. And here's where the real danger lives. Modern finance operates on the assumption that JP Morgan will always be there. It's not just too big to fail, it's too big to even show stress. The entire offshore dollar system, the euro dollar market, the commercial paper market, the treasury repo market, all of it assumes JP Morgan's balance sheet is rock solid and infinitely liquid. But the structural reality is the opposite. Every time the Fed intervenes, it confirms that the system cannot function without constant artificial support. It confirms that leverage has reached levels where any attempt to normalize results in systemic failure. And it confirms that the currency is being debased in real time to maintain the illusion of stability. This is not a conspiracy theory. This is observable fact. If the Fed steps in to backstop JP Morgan and prevent a systemic freeze, which is the most likely outcome, it will do so by expanding its balance sheet. That means more dollars, chasing the same or fewer goods and services. That means inflation remains structurally embedded. That means real assets, things that cannot be printed, things that have intrinsic value or scarcity, will continue to absorb that monetary expansion. But here's the critical nuance. Not all real assets will perform the same. The assets that will benefit most are the ones that are outside the traditional banking system. The ones that are not liabilities of a financial institution. The ones that do not depend on counterparty performance. Gold has been doing this for 5,000 years. Bitcoin is doing this in a new form. Real estate, if it's unencumbered by debt, does this. Productive businesses that generate cash flow and hard assets do this. But financial assets, stocks, bonds, anything that has a claim on future cash flows, denominated in a currency that S being actively debased, those are fundamentally different. They can rise in nominal terms and still lose in real terms. The other critical point is that liquidity itself is becoming the most valuable asset. The ability to move, to reallocate, to not be trapped in illiquid positions when the system starts to crack, that is worth more than almost anything else. We are entering a phase where the gap between liquid and illiquid assets will widen dramatically. Markets that appear deep today will freeze overnight. Assets that seem safe because they are AAA rated or government-backed will gap down because when everyone tries to sell at once, there's no bid. This is not fear-mongering. This is structural analysis based on observable incentives and constraints. JP Morgan missing a margin call is not the cause of what's coming. It's a symptom. It is evidence that the leverage in the system has reached levels where even the most sophisticated institutions can manage their collateral in real time. And if JP Morgan, with all its resources, all its access to Fed funding, all its institutional knowledge, is struggling with this, what does that tell you about the rest of the system? Here's the final piece that ties this all together. The reason this matters right now in late 2025, going into 2026, is because we are at the end of a long cycle of monetary expansion that started after the 2008 financial crisis. For 15 years, central banks have suppressed volatility, suppressed interest rates, and inflated asset prices. They have created the illusion that risk has been eliminated, that markets only go up, that liquidity is infinite. But the structural forces underneath, the debt, the leverage, the unfunded liabilities, the trade imbalances, none of that went away. It all got bigger, and now the bill is coming due. JP Morgan missing a margin call is the canary in the coal mine. It is the signal that the system is reaching the point where the internal contradictions can no longer be papered over with another round of liquidity injections. The Fed will try. They will absolutely try. But each intervention will be less effective and more costly in terms of currency debasement. And at some point, probably sooner than most people expect, the market will stop believing that the Fed can control this. That's when the real repricing happens. That's when the assets that are outside the system, the ones that don't eat tea, depend on the Fed, S credibility, or the banking system, S solvency, will separate violently from the assets that do. So when you see headlines about JP Morgan missing a margin call, understand that this is not just a technical glitch. This is not a one-day story. This is the system showing you in real time that the leverage is unsustainable, that the liquidity is drying up, and that the central bank's ability to hold this together is reaching its limit. The question is not whether this unravels. The question is how fast and how violently. And the answer to that depends entirely on whether the Fed is willing to destroy the currency to prevent the unraveling. Based on everything we've seen over the past 15 years, the answer is yes. They will print. They will intervene. They will backstop. And in doing so, they will confirm exactly what this margin call is already telling us. The system is broken, and the only way to keep it running is to debase the currency that holds it.